our mind is always divided into the right side and the left side. We have got an IQ side, which is the intelligent side, and then we have got the EQ side, which is the emotional. And because of that, what happens is more often than not, we enter into a trade with a lot of intelligence. Oh, there is a crossover, or there is a technical, or there is a breakout, or there is a support, there is a resistance. We do a lot of analytics. We do a lot of analytics when we enter into the trade, right? And that is basically where our intelligence portion comes into the picture. But the moment there is a loss, right? The moment there is an M2M loss, the moment your client starts calling you, your manager starts calling you, and saying that this trade is not going the way we had, anticipated that it would go, the intelligence stops and the emotion starts taking. What happens is that, because we are not able to sustain with our losses, we don't know when to cut the loss, we don't know when to take the profits. What happens is more often than not, the moment the trade starts going against us, we cut into our losses, right? And the moment it starts going to our profit, we take a little bit of profit and get out of it, right? So what happens is that the emotion part of our psychology starts kicking into every trade, right? And the more the market becomes difficult, the more you would see this kind of a phenomena where you need to become systematic. If you don't become systematic and if you let emotion kick in into your trade, it would become more and more difficult, to make money in this kind of a market. Right? And that's the reason why systematic trading strategy becomes all the more pertinent. Yeah, these are also these are also exhibits. Yeah, check it. It shows we need to become non-emotional, and that's basically where we need to become systematic. Now, talking about systematic trading strategies, we really don't need to build very complex kind of strategies. We don't need to do what an FI does or what an institutional player does. Simple rules, simple technologies or simple techniques which you basically see on your trading floor every day. Even within our company, we like to sit with the traders. Because when we sit with the traders, what we basically see is what they are doing. And they've got these rules which they keep coming up with every now and then. These are really good golden rules, I would say. And one trader that I was talking to a couple of months ago, he told me that, Manish, I always see in this market that after 2 o'clock in Nifty, if the market takes a particular direction, it continues to go in that particular direction. Because after 2 o'clock, the European market opens. So Nifty more or less knows that which is the direction it really needs to follow, right? So if you basically take a trend and say that the trend is basically going to go in this direction after 2 o'clock, right, till 3:30 the trend more or less persists, right? Very good rule. Again, works for like about 60-70% of the time in the market, right? Very simple rule again. It's nothing very complex. Another trader came up to me and he says that what I've seen is that basically in the market, if you have 3 successive days of downfalls, right? 3 days the market continues to fall. On the 4th day, invariably there is a rise, right? Or the market takes a gap up, or basically ends up being in the positive territory. So 3 days of gap down leads to 1 day of gap up, right? Or probably 3 days of gap up leads to 1 day of gap down. Again, a very simple rule, something that you can test, you can basically implement, you can see how it basically works, right? So the idea is that whenever you're trying to build upon the rules, you're trying to build upon strategy, you need to first of all work a very simple strategy which you already know. Right? You don't really need to go into something which is very complex and apply like sort of Archimedes principle into that to or a Newton's law to basically come up with trading strategy. Right? Whatever you observe on a day-to-day basis, I came up with this simple sort of a trend following system. Have you all heard of MACD, moving average conversion strategy? It's a normal technical analysis, just like a moving average, right? It's a moving average. It's sort of a moving average. So what you do is you basically use a moving average whenever you want to do a trend following kind of system. Now I came up with a very simple sort of a moving average phenomena which would trade on an intraday basis. And I've got this really bad habit of whenever I come up with a simple rule, I want to apply it on all the stocks possible under the sun. So if there are 200 stocks trading in Nifty futures, I would like to apply it in all 200 of them. And then it was working on some, it was not working on the other, and I always had some kind of problem. A trader came up to me and he said, if you're applying this on an intraday basis and if you're trying to see if your moving averages are working or not, I would suggest that you apply it only on very volatile stocks. When I say very volatile stocks, I mean very high beta stocks like DLF, JBS, Sterlite, Hindalco, something which has a range of 4 to 5, 6% in a day. If you apply it on low beta stocks, like for example Hindustan Lever, ITC, Rinbaxi, which does not have very large movement, moves for about 0.5%, 1% every everyday sort of thing. No matter what kind of trend following system you apply it on an intraday basis, right? So the idea here is that you need to build on the roots. Number one. Number two, you need to understand what kind of stocks, what kind of asset class you can basically apply them. Right? That's basically where the birth of systematic trading strategies come from. Talking about how basically systematic trading strategies came into the picture historically. Again, it came from a very simple sort of a phenomenon. So back in 1980s, there's a company called Morgan Stanley, a big brokerage house, and they were given a problem. They were basically given $100 million worth of Ford, the stocks of Ford. Ford is an auto company in US, and it trades publicly. Listed companies, they were stocks of Ford Motors, and they were given $100 million worth of Ford Motors to basically sell into the market. All right, and now they have the basket of $100 million of Ford, and they have to sell it in the market. The moment the market opened and started sort of trading, Ford started going down. Right? So they had this problem that they had $100 million worth of Ford to be sold in the market, and they did not have enough liquidity. And the moment they were selling it, it continued to go down. So at some point in time, a very bright chap, again on the trading desk of Morgan Stanley said that, if we cannot sell Ford, why don't we sell General Motors? General Motors is another auto company in US and trades very similar to how the Ford Motor trades. And during the 1980s, they were the top two. In fact, they are still the top two, but at that point in time, they were more lucrative. They were the top two selling auto companies in US. Right? Now, again, a very simple sort of a rule. The rule which basically appeared here was the fact that there are two auto stocks, right? Both belong to the auto, auto manufacturing parts. Auto manufacturing company. So, given everything else, all the macroeconomic factors being the same for them, the two stocks should move in tandem with each other, right? And in case if one stock goes down too much, then, and if there is no fundamental reason for that, there's no earning announcement, there's no management problem with the stock, the other stock should also go down, because overall the auto sector, should move in tandem with each other. But because Ford had gone down too much, and General Motors stayed where it stayed, some bright chap came up and said that, if you cannot sell Ford in the market because it's gone down 3.5%, let's start selling General Motors. Right? So they started selling General Motors. And it so happened that they were able to hedge their book and sell, $50 million worth of General Motors and, sustain on not having the kind of losses that they could have had by selling Ford at the bottom. The idea here being that, again, it was a very simple rule. It was a rule that two stocks in the auto sector should move in tandem with each other, and whenever they're not moving in tandem with each other and having a sort of diversification, they should start converging back. Right? Now, this simple rule gave basically rise to one of the first sort of a systematic trading called pair trading. Right? If you've heard of pair trading, it's like two stocks which are in the same sector. Right? Whenever they move in tandem with each other. Whenever there is a diversification, you take opposite position. So in case if one stock goes down, the other goes up, you go long the stock which has gone down, and you sell the stock which has gone up. And the moment they converge back, right, you basically end up making money. Right? It's as good as saying that you've got a husband and a wife. Right? Now, most of the time they should move in tandem. They should move together. Right? But during the short term, there will be bouts, there will be fights, right? And they'll stop talking to each other. Right? They'll stop talking to each other for 2 days, 3 days, 4 days. And finally, at some point in time, they'll again start talking to each other. Right? So there is a divergence between them. And after a couple of days, probably there is a convergence. I mean, as long as it does not lead to divorce, right? And it converges back, it is fine. But if it leads to divorce, it's a different game. It happens in stock market also. Two stocks move in tandem with each other. Suddenly there's a divorce. You see ICICI, HDFC Bank, they're moving in tandem all throughout 2008-9. Suddenly ICICI Bank started underperforming and HDFC Bank went through the roof. Right? So there are times when there is divorce between the husband and wife and so on in stocks. Right? But the idea is basically this phenomena basically gave rise to pair trading. And Morgan Stanley from 1982 all the way up to 1987, October crash of the market, they made about close to $15 billion just by doing pair. Simple systematic rules that they followed that two stocks should move in that. So the idea is your rules need not be very complex. Right? Most of the time people think that, oh, if you're talking about systematic strategy, the rules have to be very complex. It has to work through a lot of discipline, things like that. But that's really not the case. Right? Your rules can be simple. Whatever you observe on a day-to-day basis, right? Whatever you basically see on a day-to-day basis, and then you start applying. Application is more important. You have to apply not only on on stock, but you also have to understand, your rules work on what kind of an environment. See, we've got like 1,000 stocks to clear out. We've got 200 stock futures. Not many countries are lucky as ours to have 200 stock futures. South Africa and India probably the only countries in the world which has got stock futures which are so liquid. So you can actually short, stock futures and you can still do a lot of stuff. So if you've got 200 stock futures to play around with, there's so many things that you can do. You can play on high beta stocks on a trend following side of a system. You can do pair trading, between the stocks that move in tandem with each other. Right? If you're doing, if you're trying to play simple sort of a mean reversion where the market has, the market stays in a very tight range, you can play on low beta stocks. So you can do so many things across the length. What happens most of the time is whenever a rule starts working, people start thinking that, oh, it's going to work on all 200 stock, it's going to work on Nifty, it's going to start working on commodities, currencies, everything. That's really not the case. It works on a case by case basis. So depending upon what kind of rules you have made, what kind of strategies you have made, you need to find out what kind of stocks they work on in the scenario. Right? What kind of stock they don't work on. Only then you will be able to basically, distinguish between the rules. Right? That's basically what is important. So talking about building of strategies, building of simple systematic strategies. I'll not get into technicals because this is not a workshop on technicals, and I'm sure that when it comes to technicals, you people have worked on more technicals than probably I have. But what I'll do is I would assume that some of the technicals you already know. You know what a support is, you know what a resistance is, right? You know what a moving average is. Simple technicals is something that you already know, and then we'll build on top of them because only then it would be a fruitful system. Everybody is comfortable with technicals here, or should I give an introduction on technicals? Normal technicals, everybody is comfortable, right? Because otherwise it will be a waste of time to get into the technicals, right? So let's start to understand that what we can use, right, to build on a simple trading strategy. One of the most important factors whenever you talk about building of trading strategies is basically whatever stocks you consider, whatever asset class you consider, you need to understand what is the volatility of the asset class, right? When we talk about the volatility of an asset class, what we mean is important. So let me try and help you understand what is the volatility of an asset class or a stock. Right? We have about 20-25 people in this room. Suppose if I were to ask you, what do you think is your view where the Nifty market or the Nifty as an index is going in the next 1 year, right? If I were to ask everybody in this room, everyone would have a view. Right? Or let's assume that you just have a semi view. Somebody will say up 20%. Somebody is bearish. He'll say I think it's going to be probably down minus 10%. Somebody else I ask, he'll say probably it's going to be up 30%. Somebody else I ask, probably up 15%. Everybody has a view in this one, right? Suppose I take the average. I take the average of all of these views, right? So if I take an average of all of the view, and suppose the average comes to say 15%, right? So what you're basically saying is your average is 15%, which means that on an average, market should move up by 15% in the next 1 year, and that is the consensus in this room. But we all know that this is no Newton's law. It's not compulsory that market is going to move up by 15% in the next 1 year. Right? It can move up more than 15%. It can go down more than 15%. All right. So I'll describe here something which we basically call as the volatility of Nifty. And suppose that the volatility of Nifty is 20%. Alright? Suppose if I say that the volatility of Nifty is 20%, then what we basically mean is that with respect to 15%, the market can go down by 20%. Alright? So 15% minus 20% is minus 5. Or with respect to 15%, market can move up by 20%. Alright? So if it moves up by 20%, then it's 15 plus 20. So that comes to 35%. Right? The theory of volatility, or sometimes it's also called in mathematics the standard deviation. The theory of volatility says that there is a 66% chance. There is a 66% chance that the market are going to stay, or your Nifty is going to stay between minus 5 and plus 35%. Alright? But again, this is also no holy grail. We know that market can move down more than minus 5, can go up by more than 35. If you see a year like 2006 and 2007, market were up 50, 55, 60 odd %. If you see a year like 2008, market was down 55%. So we do not know. Markets can have a range which is more than this range. So suppose I go down further, right? So with respect to -5, I go down further by 20%. So I come to -25%. Alright? Or with respect to 35, I go up by another 20%. So 35 plus 20. So that comes to 55%. Now the theory of volatility says that there is a 95% chance. There is a 95% chance that the markets are going to stay between -25 and plus 55%. Right? Now obviously markets can go down even more than that, but there is a 95% probability the markets will stay in between -25 and plus 55%. Idea is this particular number here, the volatility number, is probably one of the most important numbers that you need to consider whenever you're building any kind of systematic trade. The more higher this number is, suppose this number was not 20, this number was 30, right? With respect to the average, you can have more movement, right? You could go down by 60, you could go up by 60. If this number was not 20, if this number was 10, then with respect to your average, you would only go up slightly or you would go down slightly, you would not go up or down too much, right? So the idea is, the higher this number is, the more volatile your asset is, the more volatile your market is. Lower this number is, lesser is the risk. Higher this number is, the volatility, higher is the risk. Higher is the risk in terms of any trading you do. Higher is the risk in terms of any strategy you do. Lower is this number, lower is the risk. But if lower is the risk, lower is the return. Right? Higher is the risk, higher is the return. Right? So the idea is, this volatility is a number which measures risk. Alright? So suppose if I were to ask you that, when you do a fixed deposit, when you do a fixed deposit in your bank account, what do you think is the volatility of that? What do you think is the volatility of the money that you put into your bank account and you do it? What do you think is the volatility? Zero? You think it's zero? So it is zero. Why? Because if I put my money in the bank and the bank is saying that it's going to give me 7.5% return, it is going to give me a 7.5% return at the end of 1 year. It's not going to give me 7.4, it's not going to give me 7.6. It's going to give me exactly 7.5. So there is no risk, there is no volatility. The average is 7.5, that is basically very strict. There is no probability that I'm going to give this much or probability that I'm going to give that much. There is no risk involved. Right? So fixed deposits are supposed to be the most riskless sort of asset class that you would have. Right? If you talk about the grades of asset classes, commodities are the most highly volatile asset classes. Things like natural gas, gold, silver, they can move up by 40-50%, in a given year just like that. Alright, probably not gold, it will always go up, but all the other asset classes. If you talk next in the grade, then you've got equity, which has about 15-20% sort of volatility. You go to the next layer, then you've got currencies, which has volatility of about 8-10-12%. Right? Then there comes basically your US treasury, your treasuries, which is not liquid in the Indian market, the treasury like the debt and all that stuff, and then basically the fixed. Right? So as long as you don't understand this concept of volatility, you really cannot develop good trading strategy. Any kind of trading strategy that you develop, you need to understand and then apply this particular phenomenon.
Volatility is, can you calculate daily to daily basis or weekly?
You can calculate daily to daily, weekly to weekly, minute by minute, second by second, hourly, anything you want. Yes, I'll show you a demo. I'll show you a demo on how you can do that. In Excel, if you're doing this, everybody is comfortable with Excel here. Can I take an example of an Excel? Right? In the Excel, if you take, suppose in this room, I had asked, what is the average that what do you think is your perception of the market? Suppose this gentleman told me -20, he told me +10, he told me -5, he told me -15. I can put all of those numbers in the Excel. If I do equal to average, AVERAGE, I can take the average of all of those numbers. That is the average. If I do STDEV, standard deviation, right? In the Excel, you just need to type STDEV. Alright, so let me just show you in an Excel sheet so that you're more comfortable. Take a view of everybody. Suppose somebody was told me -20% was bearish on the market. Somebody was bullish on the market, he told me 12%. Some other person was again bullish, he told me 23% is what market is going to go up. Somebody was very, very bearish, so he told me minus 45%. Right? Suppose I just take some random numbers. Alright? Now I've taken all of these numbers. So suppose these were the views that everybody had with respect to the market in terms of percentages, right? I can take the average of these numbers. So my average is going to be AVERAGE, average of right? Now if I were to take the volatility of this number, I would do equal to STDEV. Alright? I'll do an STDEV and I'll take all of these numbers. So if I do an STDEV, I'll email you the sheet later. Once I develop the sheet, I'll email it to you later. So you can also have a look at it later. Alright? If I do an STDEV, I'll get a standard deviation. So in this case, the standard deviation is 25%. Your average is 8% and your standard deviation is 25%. Alright? That means with respect to 8%, my market can move down by 25%, which means it can go down to